Thank you all so much for joining us today as we join with Nicola Beswick to look at understanding insurance payments and thinking about the personal tax implications that payouts might have. I'm Andrea Salmon, one of the Education and Wellbeing Program Coordinators, and it's my pleasure to be hosting the program today. In the spirit of reconciliation, MS Limited acknowledges the traditional custodians of country throughout Australia, and we acknowledge the connections to land, sea, and community of our Indigenous peoples. We pay our respect to elders past, present, and emerging, and we extend that respect to all Aboriginal and Torres Strait Islander people with us today. So no matter where you're joining in from, we are pleased to have you. I'm currently on the lands of the Wurundjeri people of the Kulin Nation. It is my pleasure to introduce you to Nicola Beswick. Some people might have met Nicola before because we actually have a series of webinars led by Nicola, and they're all available on our ms.org.au website and in our webinar library. So we would encourage you very much to go back and find other programs that might add to your repertoire and knowledge. Nicola is a financial advisor, mentor and confidant who empowers people to create a financially certain future, free from stress and uncertainty. She's a certified financial planner and an accredited aged care professional and an SMSF, self-managed super fund, specialist advisor. And she's currently studying a Masters of Financial Planning. So it is always a pleasure to have Nicola with us, and I'm going to click a couple of buttons here so that she can show us her slides.
Well, thank you for that introduction, Andrea, and welcome everyone. It is lovely to join you today. Today's webinar, we're going to talk about insurance payouts and the personal tax implications of these payouts. Now, some people may be here with different stages, so we'll cover off things broadly, and then maybe if we've got time in the end, we can look at other certain things. But for those of you who don't know our situation, I am here on behalf of the Pro Bono Financial Advisor Network, and our mission is to really connect people who are going through a time of financial hardship, particularly those that are undergoing a health crisis, to connect them with financial advisors who are part of our network and want to provide pro bono financial advice to those people. As Andrea has kindly introduced me already, my name is Nicola Beswick, and I have a range of qualifications and work as a financial advisor and have done for some time. But I have come from a particular organisation where I work through FMD Financial, and one of the key things here is everything we will talk about is general. So if you do have any specific questions around your situation, please contact someone to get specific advice, and that's where coming through the network is particularly important. But one of the things that led me to become a financial advisor, and for those of you who may be new today to listening to me, is this is my dad here. My dad was diagnosed with multiple sclerosis a number of years ago, and he was one of these people that had an income protection payout, and that allowed him to essentially not worry about finances for a good 10 years. And he's my inspiration to become a financial planner and also talk to you today on behalf of the Pro Bono Advice Network. Today, we're going to cover off a lot of different things relating to insurances. I'm going to start with a quick summary of the different types of personal risk insurances people can have. and give you some guidance as to look on your superannuation statement to see what cover you might have, and also run through the process of applying for the insurance payout, and also some really key essential things to be aware of, particularly when it comes from the tax aspect, and what you need to take into consideration when you get to the stage, and why engaging with a financial planner, particularly throughout this process, is particularly important, because there are so many different things that you have to look at, and it's really, in my mind, one of those really nice essential things to do to make sure that you're not avoiding pitfalls, I think, is probably the way to say it. So let's start off by covering off the 4 different types of insurances people generally have. These are life, TPD, trauma or critical illness, and income protection insurance. Now, what do these insurances all cover off? The key thing here is really to look at, sorry, I'm just moving that there. The key thing is to look at what do these insurances give you. Income protection, business expense insurance, critical illness, life and TPD all cover and provide you as different type of benefits. Income protection as a monthly replacement of your income, with the other 3, critical illness, life and TPD, give you lump sum payouts. And they're particularly useful to understand when they may be related to you, which is what is outlined in that light blue slide there. You can see, particularly with life and TPD, it's really key to have a look at this, particularly if you're, like many of you listening today, probably in a situation where you've got a medical condition that you need to manage and sometimes prevents you from working, and if you've also got debts and dependents, where you have a look at income replacement or the income protection insurance that helps maintain a level of income. So let's look at this in more specific detail. So life cover. Life cover gives you a lump sum, particularly which is related to you when someone passes away or is impacted with a terminal illness. I'd imagine that not a lot of people today will be listening and thinking that this situation fits with them, but it's key to understand that this cover exists. Compared to something like a TPD or a total and permanent disability cover, now this gives you a lump sum if you are totally and permanently disabled and unable to ever work again due to that illness or injury. Now, there are a whole range of different definitions that essentially each insurer looks at, and it's really key to understand that when we look at TPD cover, this is the criteria that they generally look at. And I would imagine that a lot of people here today will be thinking that this may be the type of insurance cover that is appropriate to them and their situation. But again, it's key to make sure you get some specific advice around that. There are different types of definitions that insurers use when they look at TPD, and particularly looking at potential payout. And this is a very detailed slide that covers off the 4 main ones. But essentially what we would look at from a financial advisor perspective is the own occupation or any occupation cover. Now, this is particularly related to what your current work situation is and what you're trained for. There are other things like home duties and activities of daily living, not necessarily as frequently covered with particular insurance policies, but it's good to know that they exist, particularly when we're looking at those TPT definitions if you're ever looking at claiming. Then we have income protection cover. And income protection cover covers you when your illness or your injury leaves you unable to work, and it gives you a monthly replacement. So it's not like a lump sum. It is think of it as an income, but paid through an income protection policy insurance. Now, you don't have to be completely disabled. It is very different to the TPT definitions, where it is some disability but not completely disabled. Again, it depends on each policy within the insurance documents. That is key for understanding this. The key things with insurances, with income protection insurance, is looking at other key things. So employment status, occupation, and pastimes are all key things that an insurer will look at. And this is particularly important depending on what may have happened when you've taken out your policy. The next one, and maybe not so applicable, is trauma or critical illness cover. Now, this provides a lump sum benefit when you're diagnosed with a listed medical condition. Now, this is a very specific types of insurance cover that people have, and maybe not so relevant to those that may already have a pre-existing condition, but particularly important if you're looking at your overall situation. It provides a cover or payout when people are diagnosed with specific medical issues such as cancer and so forth. And it is very specific more to the event, and it doesn't look at your ability to work. That is a very different part of the criteria with this insurance compared to TPD and income protection. So that covers off the four key insurances: life, TPD, income protection, and trauma/critical illness. But those of you listening today, the key insurances that you may want to look at, particularly with your situation, is income protection and TPD. And a lot of people that I see through the Pro Bono Financial Advice Network, they don't know that they're covered already. And particularly when there's so many things going on, when you're newly diagnosed or your MS symptoms progress, you don't necessarily think of all the different things. So I wanted to give you some guidance, particularly to make sure that if you are in a situation where you don't know if you've got cover, particularly if you haven't taken out personal cover, look at your superannuation statement and see what cover you have. And there's a couple of things that you can do to look at this. These are a couple of statements that I've taken on the internet, so they're not real people, they're fictitious. And the takeaways, like you can see in this statement here, is there's generally a little box that says what your insurance cover is. You can see here in the circle part that I've magnified, they've got a list. We've got death, which is death or life cover. We've got the total and permanent disability cover, and then salary continuance, which is also complementary to the income protection side of things. So again, one section to give you some ideas to see what cover you may have. Or it can look like this as well. So this is another example of the type of statements that exist out there. And you can see that this person has total and permanent disability and a death benefit there as well that I've highlighted. Or if you can't see a particular box like that on your superannuation statements, you can always check to see what your fees are. And if you've got an insurance premium and a fee deducted there, like you can see on that top circle, that always gives you a clue to show that you've got some kind of insurance cover there. And you may also be able to see something very similar on that bottom circle that shows you your cover that you have and then leads you to your insurance section. Again, if you can't actually find a specific section that talks about what kind of cover that you have, give your insurance, your superannuation provider a call, and they will be able to give you a rundown of that. So you found a particular section around that, and one of the key things that people always don't know is what happens throughout that claim process and what the course of events are through this. So what I've done is quickly given a summary for what people can expect throughout that process. So one of the key things is, firstly, if you're in a situation and you may want to claim. Now, again, I would advise getting some specific advice before you actually look at doing this. It's particularly important that you make sure that you understand all the specific nuances to your specific cover before you look at going down this route, and particularly understand what you're going to do with the cover if it's especially paid out. But once you've covered off that, it's letting your provider know. This can be directly or through the superannuation account provider. They will then acknowledge your instructions, and you will be appointed a claim manager who will then let you know what to do and what needs to be completed. One of the key things though with any insurance claims or review from an insurance company is they will look at what the specific policy is that you have and what the definition is of the particular insurance that you're looking at claiming on. And this can be found in a lovely thick document, which is hundreds of pages long sometimes, called a product disclosure statement or a PDS, and these documents are continuously updated. And it's about looking at the definitions, and I've taken some screenshots there of the specific definition for one policy and what in this case, a total and permanent disability definition part of is. So this is where getting some assistance becomes really important, because there are key things that you need to cover off on. And a lot of the cover offing on and proving that something is of relevance to you if you're claiming is submitting a claim which has a range of different information. So this is getting information from your medical professionals, sometimes 2, maybe 3, which could be 2 specialists plus a GP, understanding what your education and training experience is, and also getting statements from your employer as well. Now, once all of this information is provided, then you will then go through a period where the insurer will assess your claim. They may ask for further information depending on what your situation is, but sometimes this claim process can take a very long time, generally 6 to 12 months, sometimes longer, depending on what the situation is. But one of the key things to really understand is the claims manager is your point of contact with anything, and they will be communicating the various outcomes of your claim. Now, once you receive the money, assuming your claim is accepted by the insurer, and it is important to realise that sometimes a claim may not be accepted, but once it is, then the money is paid to you. Now, this can be paid directly into your bank account if the policy is owned directly by yourself, or into your superannuation account if the policy is owned by your superannuation account provider. Now, this gets really tricky because what you need to also take into consideration is if the money goes into your superannuation account, you have to then meet a condition of release for superannuation criteria to be able to then receive the money in your personal name. Now, that's great. We've just gone through the whole process of applying for a payout, and you think you've jumped all the hoops, but if your money's in superannuation, then this is where it becomes really important to understand what options you have. And this is a little graphic that really gives you an idea as to what I mean by that last slide. The superannuation fund receives the insurance proceeds from the insurer there, and then you have to meet a condition of release with the superannuation fund to get the money to yourself. So what is a condition of release for superannuation? Now, the two that really apply are the points number 2 and 3 there. Permanent incapacity. So essentially very similar to the TPD definitions. If you cease to be gainfully employed and are really unlikely to engage in gainful employment for which you are qualified, or temporary incapacity. Now, very similar but yet very distinct differences in terms of the definitions that you can see there. And both of them have very different impacts for how you can receive the funds. So permanent incapacity, you can get a lump sum, or temporary incapacity, can't get a lump sum, but can be paid as a regular income stream for the time that you're incapacitated for. This is particularly if you're suffering from an illness or an injury where the specific symptoms don't prevent you from working for a particular point in for the rest of your essentially working career, which is very different to the permanent incapacity aspect. So we've gone through a whole range of paperwork and getting through this, but what are the key things that you need to be aware of to maximize your payout, particularly when you get to the stage? And I'm going to focus on income protection and TPD because today a lot of you listening will probably be looking at these types of insurances if you're in the situation where you're not sure whether you want to go down this route or not. So let's start with the taxation of income protection proceeds. So you've got a payout or you've been accepted in terms of your claim. Now remember that this protection gives you a monthly replacement of your income due to illness or injury that prevents you to work. Now, income protection benefits are taxed like normal employment income. So that means they're taxed at your marginal tax rate. I've got a lovely diagram there that shows you the different tax rates of the current financial year and what the percentage of tax is. So what can you do? This is complicated because what you want to do is you want to make sure that you're getting the most out of the income coming in, and the strategies that you can apply in terms of reducing your income tax, like anything that you would normally do, you have to look at it in the same way with income protection. So this is where it becomes really important to get advice and make sure that you're not undertaking any specific strategy that you may have normally taken, such as putting additional money into superannuation to get a tax offset, or spending money to potentially on something like a tax deductible nature to be able to get that reduction in tax. Again, everyone's situation is very different, so it pays to make sure that you get specific advice before you implement any specific strategies that may decrease the amount of tax you pay on your income protection policy. So I know I haven't necessarily given you specifics there, but my key takeout with this is make sure that you do get some advice with this. But if we focus more on TPD payouts, again, this payout is a lump sum for people who have been totally and permanently disabled and are unable to work ever again due to that illness or injury. Now, depending on how your TPD policy was paid, depends on what your tax implications will be. If the policy is held by you personally, i.e. not through your superannuation fund, generally you receive this lump sum tax-free. If it's held through superannuation, however, then you can get the lump sum paid into your superannuation account. So remember, it gets into that entity and forms what we call the taxable component of your superannuation. That's great. So what does this mean? Superannuation consists generally of 3 different components, and their tax status are very different. We have, firstly, the tax-free component, which is essentially not considered assessable income if the money comes out of superannuation and is paid to you tax-free. Taxable component, now there are 2 different types of components here. There's a taxable component and an untaxed component. And the amount of tax that you pay on these 2 components then depends on how you take the money, whether you receive the money from superannuation as a lump sum or as an income stream, and whether you are under or over what we call preservation age, lovely superannuation term, or over the age of 60. So lots of different moving points here, and it's particularly useful to look at some examples as to what I mean by this. Now, as I just highlighted, the key thing here is the TPD proceeds are not automatically received as tax-free. Only if you're over the age of 60 they are. Now, if you are under the age of 60, then they do form part of the taxable component, and they can depend on terms of the amount of tax you pay on the amount that you may take as a lump sum or as an income stream. Now, this again depends. So I've got one example here. This lady by the name of Debbie, completely random in terms of her situation. She's got 2 superannuation funds, and you can see I've got superannuation fund 1 made up of different components there. That totals $130,000. Superannuation fund number 2, total of $400,000, again made up of different components, which you can see the total of in the bolded column there. Now, if Debbie is age 59 and she takes the proceeds as a lump sum, you can see the amount of tax that she would pay on each of those components. Tax-free components, tax-free, but the taxed element, you can see there, she pays just over $20,000. With the untaxed element, she pays $18,000. Now, if you look at her age, if she was 20 years younger, the amount that's paid on that taxed element there can be a lot higher. The untaxed element is the same. So it's key to understanding this, because there are other things that we can do to minimise that taxed element there and effectively increase the amount of superannuation payout that she may receive. Now, if Debbie is a same ages but takes the proceeds as an income stream, again, we've assumed here that she takes a pension of $45,000 a year, and you can see the different percentages based on the different components that she of that $45,000 that are tax-free or taxed, or the untaxed elements. Again, we've got Debbie at different ages, and you can see the different tax implications of that income stream. At age 59, the taxable element, so tax-free component, is still tax-free regardless, and that's always going to be that 21%. Where the taxed element, if she makes sure that she uses the disability super benefit, particularly at age 39, then the proportion of that amount will be taxed at her marginal tax rates with an offset of 15%. Or if she doesn't use the disability super benefit, then that offset doesn't apply. Then the untaxed element is essentially no offsets and taxed at her marginal tax rate. So this is where understanding what her other income sources, particularly in her own personal name, become really important for her to understand and what that marginal tax rate might be. But we can do things to increase the tax-free component, and it involves a very special, lovely formula that I've put on that screen there. And I'm not expecting you to go away and work this out. This is something that your specific provider will be able to assist you with in terms of if you go down the route of getting some advice. And what this does is it actually increases that tax-free component, which I highlighted previously is tax-free, and that helps us minimize the amount of tax that you would necessarily pay upon getting a lump sum. Now I'll give you an example here. This is David. He is 44 and receives a TPD payout of $180,000, which is all taxable. So there's no untaxed or tax-free components. You can see that if David doesn't do anything with this lump sum and doesn't undertake some of the strategies that we can do, such as rolling over into a new superannuation account, or looking at other things that he could potentially pay up to $36,000 of tax, compared to if we did something different where he could potentially pay a lot less tax. So we've got here reducing that 36 to 17,000, and therefore increases the amount of the proceeds that he gets from his superannuation balance if drawn out as a lump sum. Now, I've probably confused you all a lot with a whole range of these different things and different formulas and different components. And yes, even my brain hurts going through this all. Well, not really, I actually quite enjoy it, but this is the reason why you want to engage a financial planner. We particularly are looking at these key things that help make sure that you are maximising your payouts, particularly because there are a little bit of tricks and traps in there that we wouldn't expect people that are not trained in this profession to know. So the key things that you need to consider before you actually undertake this process is thinking about how you want to receive your money, an income stream or not. Do you want to leave it in superannuation or draw it out as a lump sum? Or do you want to completely take it out of the superannuation environment? But if you do that, what are you going to do with the money? Particularly when you want to probably try and maximise that lump sum for a period of time, and whether you want to invest that and how you invest it, whether you invest it in your personal name and compare that to the superannuation tax environment, which is and can be quite generous depending on someone's overall situation from a personal perspective. The other things that you need to also consider is the impact Centrelink. Now, many of you that may have gone through a TBD claim or are thinking about that may also be eligible for the disability support pension, again, depending on whether you meet their specific criteria or not. And it's important to understand what and how that lump sum, if you receive a TPD payout, impacts your entitlements from a disability support pension perspective. Now, do you want to hold the money in accumulation and not have it counted as an asset, assuming you're under pension age, or do you want to take the money out of superannuation? Now, that is a topic in itself in terms of the impact of Centrelink and the different types of aspects we consider for someone when they're looking at an insurance proceeds payout, particularly with TBD, and we covered this off on one of our previous webinars. So I would highly encourage you to go back and listen to that webinar if you wanted to understand those specific nuances a little bit more. So these are the things that financial planners consider. Not only do we look at the Centrelink aspects, which is what I briefly touched on before, but looking at how you can maximise the income that you need to receive from any payouts and maintain that capital for as long as possible, particularly in the right investment structures and managing any tax implications. Some financial planners do help with managing claims and specifically look at this process, but then also looking at other professionals that you need to engage with. Estate planning professionals are particularly important at this stage as well, or in any stage of someone's life. So it's really key to make sure that you get that team around you. And if there's anything that I want to try and highlight today, is building a team is really important, and making sure that you get the right trusting professionals around you to ensure that you can make the best of what you have received or what you're looking at doing, particularly in what can be a very emotional time for people. Our contact details through the Pro Bono Financial Advice Network can be found on this slide here. And please reach out to us if you have any specific questions or you want us to match you with an advisor within our network. And I know I've covered off a lot of information there. If you do want to contact us, it would be most appreciated. And thank you for listening to us.
Nicola, thank you so much for a wealth of information, but presented calmly and clearly. So that's beautiful.
You're
I'm just
welcome.
going to go back over here to allow a bit of space. There are questions coming through. So just a reminder that, as Nicola said, Pro Bono is there to support you. So are the team at MS Connect, and even some almost like backward steps. There's a lot of support around your employment, and there's a lot of advice, and Nicola has stressed this, and I will stress it as well. Don't make any changes until you get advice, because the changes that you might make feeling that you need to make that change might have an implication down the track. So we absolutely want everyone to get advice before making any changes, particularly around their employment and then around their entitlements. So give us a call. There's podcasts, there's webinars, lots of resources that we try to make available to you to tap into when it's relevant. So as Nicola said about the Centrelink webinar, go back, have a look at what is there. If it's dated, we take it off. So the material that's on the website is all up to date. So please tap in. All right, let's go to some of these questions. So just a really practical one. One of the slides you mentioned disability super benefit. What is that?
Yep. It's very similar to TPD, and the terminology very interchangeable with the taking the proceeds using the permanent incapacity definition. So I probably use two terms for essentially the same thing.
Okay, cool. Does the tax happen when it comes into your super account? If you get that payout, does it get taxed going in, or is it when you draw it out of your super?
When you draw it out of your super. What happens is the proceeds will go into your superannuation account and they will form the taxable component. But there's things that you can do to decrease that taxable component or increase the tax-free component before you take it out of super. So those are the key areas why I really stress with people making sure that, like you said, don't do anything until you get advice, because there may be things that you can do to make sure that you take advantage of those things to maximize or decrease the amount of tax.
Minimize the tax. Yeah,
minimize the tax. Yeah.
For sure.
And everyone's.
Sorry.
I was going to say, and everyone's situation is really different. I've gone through the key kind of aspects that we look at, but as the nature of financial planning is, it's all specifically related to someone's unique situation, and what may be suitable for one person may not be suitable for another. So that's why I've tried to cover off on those examples a range of different outcomes that one person took, but it really depends on what they need and what's important for them.
Yeah, absolutely. That advice piece is crucial. I just wrote that to someone who had another question. So do you get taxed? It's a question about, if your lump sum gets taxed, do you get taxed again when you do your tax return?
So the tax will be payable when you take it out of super in your tax return.
And it is in your tax return that you get taxed. Yeah. Cool. A couple of, I might leave, there's a couple of questions I might leave, sorry. Sorry.
That's okay.
There's a few questions around the TPD.
Yep.
So TPD, you can, well, I believe it's actually become harder to get a TPD because there are a lot more expectations around recalibrating your role, so it's a little bit harder to get a TPD, but you get a TPD because you cannot continue the work that you're employed for. So you have to be, it's part of your super that you get because you're employed, but you can actually go retrospectively, can't you, and make a claim? How far back can you make a claim from when you were working?
That all depends on the different policies with the TPD, and it's a good question in terms of that's when you need, if you're in a situation where you want to go back and that TPD policy still exists, that's when I'd advocate getting some specific advice around that and your situation, because it depends on the insurance. The TPD payout depends on the policy that attaches and the conditions that you need to meet, depends on those specific definitions and that lovely product disclosure statement that is attached to everyone's any financial, including insurance product that exists. So you would have to make sure that what is in that definition you meet in order to give some comfort. And everyone's different, and this is where it gets also really hard in terms of saying, like anything, no one can guarantee a claim will be paid out, because it's so, and it is so hard to look at that without going through those specific things. But that's where your medical professionals and getting that specialist assistance becomes really important.
Yep. And a question around, you can claim a TPD and you might find that you can retrain in years to come to do something different and return to work. That's true, isn't it? You can have a TPD and return to work.
The key thing around TPD is it prevents you from working again. So if you're looking at if you want to be really, I guess, cautious, if you're intending on going down that route in terms of applying for a TPD and thinking that you can just get the payout and then go work somewhere else, because you don't want to make sure that you're trying to get the best of everything and get caught out.
And I think that's why they tightened everything up, didn't they? But yeah. So if you are unable to work and you are successful in claiming a TPD and you get that payout into your super, if you can leave it there and just leave it until you're eligible to access your super, like you're not pulling it out early, you're not pulling it out as a lump sum, that's a pretty good scenario.
It depends. I know I've said that a lot, but that's when understanding someone's specific situation and financial situation outside becomes really important, because there's one thing doing that strategy, leaving the money invested in superannuation and not touching it, but then you've got to make sure you're not doing yourself a disservice in terms of not being able to meet bills in your personal name, or not be able to pay for food and things like that. I mean, this is very much viewed as a lump sum because you're struggling in that financial side of things. And again, everyone's situation is very different. And to say, yes, that's a great strategy, depends on the right broader aspect of someone's personal situation.
Yep. And another little complicated one. When you talked earlier about the different insurances in our superannuation,
yep,
we we might, we could claim a TPD. That would infer that you are not working anymore. So that would also infer there's no more money coming into your super from your employer. But if you maintain that insurance component that was for death benefits, that you would then be paying out of your super, you could also have a claim on that later. It doesn't take away that separate insurance, does it?
Now, that's what I would do in that situation is check with your provider two things. That the TPD payout isn't going to impact your life payout or that death insurance amount. Sometimes it can. And also whether there's specific criteria that means you have to meet in order to keep that insurance active. And this is some key changes that came into the industry a little while ago, is if people, for example, had a balance that was quite low, then some providers would cease that insurance cover. The other aspect is if people stopped contributing, so in that example, someone stopped working and they stopped contributing, that may impact the insurance component and whether that still existed. So that's also very important to know if you decide. Some people sometimes don't realise that these changes came into effect and could completely detrimentally impact people's situation. You may think that you've got this cover, but in some respects or some instances, if the trustee of that superannuation provider went, I can't see any claims, it's been in 18 months, 2 years, depending on their specific criteria, that insurance cover can lapse. So it's really important to make sure you understand that particular criteria as well, so you don't inadvertently lose the insurance cover.
Absolutely. Yep. Great. Now, a question around this is almost a financial advice, legal advice type question. If someone is finding that they've been diagnosed with MS, they're not able to work, they've made their claims, but they've all been declined, is that sorry, I'm kind of preempting the answer, because I think that's where you can seek out some legal advice on and help with that. MS has a range of legal practitioners who are really well versed in the nuances of why MS means you can't continue your work. So if you find you're declined, I would say ring MS Connect and ask. That we've got a little list of companies that we know have a very good understanding of MS. So feel free to ring MS Connect and ask for some numbers, but feel free, Nicola, to make a comment on that as well.
Sometimes the claim, it's about understanding why the claim is being denied. Yeah. And sometimes it may be something completely easily fixed. And there are financial advisors out there that do specialize in that as well. So very similar, different approach to legal professionals, and I think we complement each other, which I think is really important to understand.
Absolutely. All right, now I'm moving direction a little bit to some questions around the income protection monthly payment versus a lump sum.
Yep.
So the first one is one better than another, and you're probably going to qualify that with it depends, but
well, income protection is always going to be paid out as a monthly payment. It can't be paid out as a lump sum.
Right.
Where a TPD payout can be paid out either as a lump sum or a monthly income. And that depends on income protection and TPD have two different criteria in terms of what they cover and what they get, and people sometimes have one or the other or both. But then your policies, when you're looking at claiming, also have different criteria in terms of health, work, different situations that insurance providers will look at before you get a claim.
Okay. So then a question of someone who is on a income protection, I'm just checking that, yes, an income protection payment. Do they have to tell the income protection payment about their Centrelink mobility allowance?
That's
My gut says no.
My gut says no either. I don't know specifically the answer to that.
Because your income protection payment is directly related to the cover that you had and the income that you had. So it's not based on any other income you might have from any other sources, as opposed to Centrelink payments.
One of the key things there would also be looking at potential tax implications as well. And the insurance providers, if they will always ask for anything that's going to be relevant for their payout as well. Because income protection is related to your income and what you were earning and how much you were covered for, it's a very different to, say, your mobility allowance or so forth. My gut says no, but I'm like you. I've never been asked that question before, so it's a good one. It's a really good one, actually.
It is a good one. Yeah. I'm just qualifying for someone who's put in that MS Connect isn't qualified to provide financial support. What I was saying with contact MS Connect, and MS Connect will very much put you in touch with Nicola and her group. So we absolutely want to connect you to the best people for your situation.
Yeah.
All right, sorry, let me just have a look here.
Great questions, everyone.
There are some great questions. Now, there's a great question that is an area I've never heard of before. So let's go. It's about Act of Grace payments. So, oh, you're looking like that as well. An Act of Grace payment is from the Commonwealth Government in lieu of super. And the question is it taxable income?
I would speak to your accountant about that.
Okay.
Cool. Because each Commonwealth payment, and the reason I say that is because each Commonwealth payment can be taxed differently, particularly the ones that I've come across, and each payments you get like a PAYG statement like we do normally with work and things like that. So that's something that if you get that, give to your accountant and they will answer that. That was a great one.
Yeah, that's a good one too. Yeah, someone has put in that their income protection payments were reduced by the amount of job seeker payment that they were getting. So mobility allowance may influence that as well. Someone else has asked about what is Centrelink mobility allowance. It's a payment that's made available to in recognition that getting to work might be difficult and you might need financial support in getting to work. Often now people have a mobility component included in their NDIS plan. So if getting to work is an issue for you, you can pursue that a couple of different ways. So speak to someone who you might be connected with, whether it's through your NDIS plan or if you're supported through Employment Support Service, or give MS Connect a call on that one. Oh, that's complicated. I'll just read this out. And it's around the income protection payment and maintaining the death benefit. If you get income protection paid, you'll also get super paid because you're getting the income protection, and that would keep your death benefit going. So do you still get super when you're paid income protection?
That is dependent on the policy someone have through income protection. So different income protection policies exist. Some cover people for superannuation payments, some don't. And depending on what that specific payout entitlement is, will answer that question. If you want to maintain the death benefit and you have to keep on putting money into super, then again, that's where checking with your specific provider becomes really important to see what their criteria is for making sure that. So as much as I'd like to say one definitive answer, my favorite word is it all very much is dependent on someone's specific situation.
Yeah.
And that's where it's getting connected to those professionals that understand this become really important.
Yep. Yep. It's such a minefield, really, isn't it? Just getting a few more comments coming in, and I actually think we might, I apologise if I haven't done justice to the questions. Some are quite detailed, so there might be some that we follow up together afterwards, Nicola, if that's okay. It does, it just, from what people are putting in, it just shows how hard it is to understand what you feel you're covered for and what you then find out you're covered for, and it's very challenging. Yep, absolutely.
And on that as well, some of the people that I've seen through this network and come to me, everyone's so different in terms of the cover and the policies and what providers want and how things are worked, that it becomes like there's very much what may be a right answer for one person may not be the right answer for another person. So making sure you get that specific advice through qualified professionals is really important, because it is so variable. For something that seems like it should be so straightforward, so variable. And the reason why I love what I do, because you can make such a difference, but really hard today to say yes, no, or
absolutely. And look, I will just totally reinforce the absolute value of connecting to Nicola's pro bono financial advice network. You know, people get very skeptical about pro bono. There's no such thing as a free lunch kind of idea, but that this program really is financial planners, financial counsellors offering their time, part of their time, not all their time. They do their fee for service work, but then they offer some time to people who are experiencing financial hardship. But in our situation, it's for people who are living with MS. So it's not demonstrating that you are in financial hardship. It's because you're living with MS. And that's the work Nicola's done because of her dear dad that has enabled that to happen. So please don't feel that it doesn't apply to you because you're actually dealing with money. It's about setting you up well for your future. So make use of the service. Please don't feel it's for someone who needs it more than you do. Make that call. All right. Thank you. There are more things coming in. I promise to check them all, and I will set up emails responding with Nicola so we can get responses to everyone's questions. It's such an important area to talk about, to get advice about, and to get our own handle on what our own situation. So thank you so much for your time putting the slides together and your time this morning.
More than welcome, and it was lovely to chat to everyone out there listening today as well. Thank you.
Thank you. We look forward to seeing you at future webinars. Thanks, everyone.